Do you ever feel like you have a dysfunctional relationship with money? Like your finances stress you out or control your happiness? Well, you're not alone. Most of us didn't learn the healthiest money mindsets growing up. That's why I'm so excited to share 11 powerful lessons I learned from the excellent book, The Psychology of Money by Morgan Housel. This book completely changed the way I think about and handle money, and I believe it can do the same for you. Stick around, because these insights will help you make smarter financial decisions, find more fulfillment, and change your relationship with money for the better. Let's dive in. Lesson 1. No one is truly crazy. While some people's financial decisions may appear illogical, but a deeper understanding of their circumstances and motivations can provide a different perspective. Our views about money are shaped by our unique situations, upbringing, goals, beliefs, and personal experiences. What might appear irrational or bizarre to one person could make perfect sense to another based on their individual context. Housel highlights that our worldview is heavily influenced by our own circumstances, which represent only a tiny fraction of global happenings. For instance, the 401k retirement savings plan didn't exist until 1978, and the Roth IRA was born even later, in 1998. These financial tools are relatively recent, yet they significantly impact how people think about money. The lesson here is that our unique mental models shape our financial decisions, and understanding this can lead to better financial behavior. Lesson 2. Luck and risk are intertwined. Outcomes can result from either good or bad luck, even when decisions are sound. In real life, we often don't bother to statistically measure if decisions were smart or not because it's too complex. Instead, we prefer simple stories even though they can be misleading. Forbes magazine doesn't praise investors who made smart choices, but still faced risks. The danger is that we all want to learn what works and what doesn't in finance and business. We look at successes and failures to figure it out. But failure isn't always a good teacher because it can make smart people think their decisions were bad when they were just dealing with risky situations. Things are rarely as good or bad as they appear. Lesson 3. Recognize when you have enough. Pursuing endless wealth often leads to unnecessary stress. Contentment matters. Warren Buffett said that risking what you have and need for something unimportant is just plain foolish. It doesn't make sense to gamble with what's important to you for something that isn't. If you expect more when you achieve more, there's no point in striving for extra because you'll still feel the same. Trying to keep up with others' wealth is like a game in a Las Vegas casino. The only way to win is to leave as soon as you enter. Lesson 4. Harness the power of compound interest. Long-term investing and compounding can significantly impact financial growth. Warren Buffett made $81.5 billion of his $137 billion net worth after turning 65, which is mind-blowing. Jim Simons, who runs Renaissance Technologies, has made impressive returns of 66% annually since 1988. Buffett, in comparison, has compounded his wealth at roughly 22% annually. Despite Simons' superior performance, he is 75% less wealthy than Buffett, mainly because he didn't hit his investment stride until he was 50, giving him less time to compound his wealth. Amidst all the books on economics and trading strategies, the most crucial advice might just be shut up and wait, represented by a long-term economic growth chart. Lesson 5. Prioritize financial freedom. It grants control over your time and life, more than your paycheck, more than the size of your home, more than the status of your job. Having the freedom to do what you want, when you want, with the people you want, is the biggest factor in making people happy. Once you understand how true this is, you realize that directing your money towards a life that allows you to have that freedom brings incredible rewards. Your kids value your presence more than they value your money or what it can buy. Working tirelessly to earn money for material possessions does not necessarily lead to happiness. Lesson 6. People care more about their lives than your possessions. The man in the car paradox. Don't overestimate the impact of your achievements on others. You may believe you desire a fancy car, an expensive watch, and a big house. However, what you truly seek is the respect and admiration of others. You think that owning expensive items will earn you that respect, but it rarely does, especially from the individuals you most want to impress. Lesson 7. Measure success by wealth and security. Flashy lifestyles don't necessarily equate to true prosperity. Wealth isn't just about buying fancy cars, diamonds, watches, and expensive clothes. It's about having financial assets that you haven't yet used to buy stuff. Singer Rihanna faced financial trouble from overspending and was sued by her financial advisor, who questioned whether it was necessary to remind her that spending money on things means you won't have the money anymore. Investor Bill Mann once said that while spending money on nice things can make you feel rich, true wealth comes from spending only what you have and avoiding debt. Being wealthy is like exercising self-control. Instead of indulging in a big meal as a reward for hard work, true wealth is saying no to unnecessary spending and actually saving money. It's tough but worth it. Lesson 8. Save for the sake of saving. Prioritize frugality and consistent saving. It's not a common task, is it? Do people really need convincing to save money? From what I've seen, many do. There are generally 3 types of people when it comes to saving. Those who save, those who don't believe they can, and those who don't think they need to. Learning to be content with spending less money creates a gap between what you have and what you want. Similar to the satisfaction you get from increasing your income, but it's easier and more within your control. Having savings in the bank, even if they don't earn interest, can still provide significant benefits. It can give you the freedom to pursue a job with lower pay, but more fulfillment, or to wait for investment opportunities that arise when others are in a tight spot, and you have the flexibility to act. Lesson 9. Tails you win. The stock market has asymmetric returns. You can lose money on most investments, but still come out ahead overall. Say you invest $100 in 10 different startups. Unfail and lose your money. But the 10th succeeds wildly, earning you $10,000 on your $100 investment. In total, you invested $1,000. You lost $900 on the 9 failed investments. But that one winning investment earned you a $10,000 return. So your total profit is $9,100, even though 90% of your picks were losers. This happens in real investing too, just on a smaller scale. Some stocks lose money, but a few outlier stocks like Apple and Amazon grow so tremendously they lift overall returns. That's why smart investors like Warren Buffett hold diversified portfolios with many stocks. Most will be mediocre or loss-making, but a handful will be huge winners that can offset the losses and drive overall profits. The key is you can't predict which companies will be outliers. So own a basket of stocks, knowing a few winners will likely emerge over time to earn asymmetric returns. Lesson 10. Room for error. You can't expect to win with every investment, so leave plenty of room for error. The best strategy is to plan so conservatively that your actual returns don't need to match your projections. For example, when calculating how much money you'll need to retire, base it on very modest returns like 1% rather than optimistic returns like 10%. Any returns above 1% will be a bonus. This conservative approach builds in a large margin for error. You also want to diversify your income streams. Don't rely solely on your job for income. Have multiple streams like side businesses, investments, etc. This prudent approach reduces your risk of financial disaster. Lesson 11. Nothing is free. Compound investing requires coping with fear, uncertainty, and doubt. When markets plunge, it's tempting to sell, but selling locks in losses. Staying invested allows your money to keep compounding long-term. View volatility as the fee you pay for higher compounded returns. Periodic plunges in value are the price of admission. Look at the market's huge long-term returns, not its short-term drops. Sticking through down markets enables ongoing compound gains. See volatility as the cost required for market-beating returns. Pay the fee of coping with uncertainty. Stay invested in bad times and good. This is one of those books that everyone should read, even if you don't like to read. Go grab a copy of this book because it will teach you everything about money in a simple way. And remember, these lessons encourage a balanced and mindful approach to managing your finances. Thanks for watching this video. Don't forget to subscribe to our channel for more insightful content on personal finance and self-improvement. See you in the next video.